All right, here we are starting with a different example, and let's see if you guys can detect how different this is from the previous video. All right, so we're still talking about accounting for bonds payable. Now, in this example, on January 1st, year one, Western Wyoming Distribution Inc. issued the following bond. So the face amount is $100,000. The contract rate of interest is 12%. It will pay semi-annual interest on June 30th and December 31st. The term of the bond is 5 years and the market rate of interest is 13%. All right, so look that over. So the first question we need to make sure we ask ourselves is this bond going to sell for a discount, the face amount, or the premium? So pause it, look through it. Remember, go through your definitions of which one is which, and let me know. All right, so hopefully you have paused it and came back with the conclusion that this bond will be sold at a discount. And the reason being is that the market rate of interest, meaning the other bonds, similar bonds out there, has a higher rate of interest. Therefore, more investors will likely flock to their bond versus yours because they'll get a better return on their investment, right? That's the goal of every investor. All right, so with that in mind, assume that the bond sells for $96,406. So I like to make sure I make this point very, very clear. This $96,406 is an amount that in this class, I will provide to you. Now, when you move on to your other finance class, you'll use some tables and different methods to figure out this amount. But in this basic accounting 1A class, I will give you this amount. Please, I repeat, do not try to calculate this answer. Don't calculate. Do not calculate this answer, okay? I will give it to you because I can guarantee you that you're going to maybe try to do 13%, something. It's not going to work, okay? So just let me give you this answer and then we'll work on it. That's the purpose of this particular area, is not to calculate this, but to determine how to account for it, okay? All right, so now we're going to journalize exactly what we're going to capture, right? So in our last example, when we were receiving cash, we did a debit to cash and a credit to bonds payable. We're going to follow that same logic, except now our journal entry looks like this. We're going to debit cash, which that is the amount that we're getting from our investors, and then we are going to credit bonds payable for the full amount. Now, what you need to know is that when you're selling your bond and it's selling at a discount, you still have to repay it at the full amount, right? You still have to repay the full principal. Now, this new account that we have in question is called the discount on bonds payable. Now, the discount on bonds payable is normally a debit. Always, most times it's a debit when you initially record it. Okay, and so you're just taking into account that, hey, I didn't get the full amount of my bond that I was trying to issue, therefore it will be a discount. You're capturing the amount that you did not receive. Okay, so again, that is just the difference between the bond payable amount or the amount you're issuing less your cash. Okay, that's how you get the discount on bonds payable. And then the bonds payable less the discount on bonds payable equals the carrying amount or the book value at the time. Okay. So the last point that I want to make before we move on is this point here. It says when a bond is issued at a discount or premium of the face amount, the amount is amortized over the life of the bond. So this $3,594, although we did not receive this amount when we issued the bond, we're going to amortize it or discount it so we as a company don't take a hit for the money that we didn't receive. What it's doing is it has allowed the company to come whole. They're not losing money. They didn't get the money that they wanted, but it's still going to offset, in a sense, it's going to offset against their net income at the end of the day. All right, let's talk more about that. So when we're amortizing a bond discount or premium, It's very similar to how we do depreciation in a sense. So if you guys can think back to chapter 9, or if that was not your favorite chapter, then no big deal. I can still walk you through it. So when we amortize a discount, a bond discount or premium, every period, a portion of the bond discount is reduced, right? So it's going to be reduced, come on, and added to the interest expense. It increases the contract rate of interest on a bond to the market rate of interest that existed on the date of the bond. So if you didn't quite understand that, or I hurried through it, what is saying that the company ain't losing no money. They're going to become whole one way or another. Maybe they didn't get the full amount from the market or from the investors, but it's going to come full circle for them so that they don't necessarily lose money. It's going to be like more so of a tax write-off. Okay. All right. So let's see what this look like. So if we are trying to capture that we didn't receive the full amount of that bond, the journal entry to do so is going to be a debit to interest expense and a credit to discount on bonds payable. Okay. So in our last example, when we initially recorded this transaction, it was a debit to cash in the amount of, I think it was $96,406. We also did a credit, a debit to discount on bonds payable in the amount of $3,594, and then our credit was to bonds payable of the $100,000. So if I can show you guys a T account of what this looks like, here's your discount on bonds payable, right? So when we initially recorded, it was for $3,594. Now what we're going to do is, over the life of this bond, we are going to keep decreasing this amount until it gets down to zero, so that we have accounted for this this discount that we did not get, the money that we did not get, right? And so the way we're going to do that is, it's called the straight line method, where we take the full amount of the discount, which is the $3,594, and we're going to divide it by the number of periods that we're amortizing it by. Okay, so the life of the bond was 5 years, and we're going to amortize this bond twice a year, just like we pay interest, right? So that's going to be a total of 10 periods. Okay, so that's what goes here, 10 periods. So therefore, every year, twice a year, every year for the next 5 years, we are going to be amortizing $359.40. So that's what's going to go here, if I can be so bold to do an arrow. So every year, twice a year, we're going to record $359.40 until that amount gets down to zero. And to do so, or to capture that, is going to be a debit to interest expense. So remember, expenses reduces your income, right? And if you are reducing your income, you're reducing your tax liability as well. So I'm going to say that again later, but I just want to make sure you understand that concept. Okay. All right. So here we are talking more about that. So this is how we are going to capture that. So this is a bit of what I went over before. I kind of jumped ahead. But when we're amortizing this particular bond discount of $3,594, we're looking at the term of the bond, which is 5 years, and we're going to amortize it twice a year. So to come up with that number is, you have the discount on the bond divided by the number of periods. And so therefore, our semi-annual amortization will be $359.40. To capture that, it will be that journal entry, right? All right. All right. So with that, I'm going to take a pause on this video, and I want to make sure I show you how we capture all of our journal entries with this particular, this instance. Okay.